Welcome to the Skeptic's Guide to Investing with Steve Davenport and Clem Miller. Every 2 weeks, Steve and Clem bring you brief investment insights you may not find anywhere else. We hope you enjoy today's episode. Here are Steve and Clem.
Welcome, everyone. This is Steve Davenport with Clem Miller as part of Skeptic's Guide to Investing. And we're sitting here on a Saturday or Sunday afternoon, and we're saying, what are we doing talking to each other about investing on the Sunday? And then we realized that all of the major business networks are all having shows tonight from 7 to 9 to talk about the sell-off since Trump's tariffs. So we just looked at ourselves and said, what would we do? And what are we doing personally? And how will the different scenarios play out over the next 3, 6, 9 months? And we just try to get to the heart of what we think might happen, and therefore don't be surprised if this also happens. Because I think that at least discussing the possibilities, I think you become a lot more settled around something when it does happen. You say, oh, it wasn't as bad as I thought, or this made that better. And it helps you to become a better investor when you look at the way markets react in these tantrum type moments. What do you think, Clem? When you look out there, do you see just stuff yelling at you to buy because they're so valuable? Or do you still see, it feels to me like the multiples come down, but not as much and as quickly as it went up the last 2 years. So it feels to me like there's still some value to come out of this market. Where do you feel?
I would agree with that. Really, there's 3 parameters around which to make some judgments. The first parameter is how much further we have to go down after Thursdays and Fridays drops. The second parameter is when will we reach a trough in the market? How long will it take to reach that? And then the third parameter is at what rate will we recover from that trough? So those are the 3 parameters. Now, when you use those 3 parameters, you can build some scenarios around those parameters. And so I've sketched out 3 scenarios here. So the pessimistic scenario is that there's a further 20% drop over the next 2 weeks. So that would mean that 2 weeks from now we will have been down roughly 30% from last Wednesday. So a further 20% drop over the next 2 weeks, followed by a 2% per week recovery after that. So now remember, 2% per week, doesn't, the math doesn't work symmetrically. It takes more than 10 weeks to recover that 20%, and it takes more than 30 weeks to recover that, or more than 15 weeks to recover that overall 30% drop.
Yeah.
So we're talking about quite a long period of time before the market actually recovers. So the first scenario is truly a pessimistic scenario. Second scenario I have, well, let's go to the optimistic one. The optimistic one is that we have a further 5% drop, probably over the next week, right? Mm-hmm. Maybe even tomorrow, Monday. And then the market goes flattish, but volatile. So I think that's probably as much of a probability as the first one I laid out, that we're going to see things kind of flatten out, but still maintain volatility. And under this 5% drop scenario, I think it's going to be a while before we start seeing the market climb back up again. And then my middle scenario, neither optimistic nor pessimistic, sort of the lukewarm scenario, is that we'll see a further 10% drop, say over the next couple of weeks, and then a 1% recovery. So not as dire as the first pessimistic scenario, but still bad relative to that. So now, if you give kind of equal probabilities to each of those scenarios, you kind of end up with the something close to the middle scenario. So
Yeah,
further,
but can you honestly say that that's the way you feel?
the way I
Like
feel, yeah.
you feel like the moderate is you think the positive right now, I have to feel that the negative outweighs the positive.
Well,
So
no,
you're
when I say my middle
those
one, I'm saying further 10% drop.
yeah,
Yeah, and then a 1% per week
but-
recovery after that.
right. But I'm saying you're offsetting the pessimistic and the optimistic or the positive. That's
Right.
basically about the same probability. And
Yeah.
I'm just telling you, based on what I feel from people talking to them about markets and some of the, let's just say, less than clear things that have been done, like, trying to tariff an island of penguins. Um, I think there's a lot of question marks in the
Yeah.
air that make me feel like I'd have to go with maybe 25, 20 or 2010, some odds of the negative being higher than the positive right now.
Um, Clearly, there's a lot of incompetence going on. You can see that across many different policy areas within the administration. Uh, that would, I think, argue for a more pessimistic scenario. On the other hand, I think, one thing to keep in mind is that what we're dealing with here is uh, a kind of top-down policy decision on these tariffs, and thus perhaps more easily rescinded to some
Yeah,
degree.
I mean,
And
I
I mean,
think
it's
it was
not
going.
COVID. COVID was something you couldn't, you had to wait for vaccines to come in before you could deal with COVID. I mean, granted the recovery occurred pretty quickly, but the real big recovery
Well,
after COVID
I
was when
think
vaccines came in.
yeah, I mean, I think you're going to the longer term, and I'm just worried right now about what is the Fed going to do.
Yeah.
Because if I was sitting here and saying, I think the Fed is on hold and there's no way they get in until we see, a quarter of negative growth, and then the Fed comes. But then I look at some forecasters and they've gone from one or two cuts this year at the end of the year to a cut at every meeting the Fed has this year and getting down to the half to 1% again. So I'm sitting here saying, well, we saw during COVID a reaction in one weekend that we never thought was possible, right? The amount of liquidity they flooded the market with by lowering 250 in one meeting was just amazing. And that's what I'm sitting here saying are they, is every system going to operate in whatever way it can? And then there are these checks and balances, like what's going to happen with, some of these things in the courts? What's going to happen with the Federal Reserve? Maybe the markets go crazy until the Fed says, we're not going to lower rates, but we're going to tell you we're aware of the volatility and we're going to do things to protect investors. I think that Trump is implying that he wants the Fed to cut and wants lower rates, and he's not afraid of causing some upset for a period of time until that happens. And I mean, I think the most callous thing he did this weekend was to go play golf in the club championship.
Yeah.
I just think it sends, even if he is the richest man in the world, I think it would be the wrong image to say to the average working class person, yeah, you're worried about your job now, you're worried about your retirement account. And now all of a sudden, he's out golfing. You know.
On the Fed, you mentioned the Fed.
Yeah, I think we
Uh,
got to go into the Fed and because that to me, you make it sound like there's one and then there's the other, and the market and then there's Trump, and they're going to have this battle. But I would say that there is this person on the sideline who's going to try to keep both of these characters in line so that it kind of, we go in a direction that's not totally market-based, but also not totally, everything can fail.
So, so a few things on the Fed and Powell is tariffs can cause recession, obviously. Tariffs can also cause inflation,
Right.
obviously. And so Powell is kind of stuck with his data, right?
Right. That's why I think this is such a unique. Not only if Trump didn't hate the power of the Fed so much, it would be one thing. But then to have them kind of back themselves into a corner where they know they have trouble if they loosen money supply now and there's extra inflation. It's like
Yeah,
they've made this bet and they just don't want to lower just because they look very hypocritical.
yeah.
And I think that Trump would look at it and say, "Hey, I texted on, Thursday and this happened on Monday." I guess it took them a little longer to realize I was right. And and I guess when I look at this, I just
And it's
wonder,
crazy. You see all these conspiracy theories now on the net
yeah,
about how, oh, well, this is some kind of 4 or 5 dimensional chess that Trump is playing that, is aimed at getting the Fed involved and, this
he's
and
trying to lower the overall debt so that when we
that.
refinance 7 trillion in the next 2 years, I saw this post, and there's going to be 7 trillion of refinancing, and they want it to be at lower rates. So what they're doing by tanking the economy is really going to save us in interest payments over the life of these loans. And I'm just sitting here going,
I mean, these
what?
are people who are trying to hawk Teslas from the White House. So
Yeah,
I don't give them any I don't give them any credence in terms of being smart about.
I guess I'm just saying for the average investor and the average guy who's listening to the news, how does
Yeah,
he determine what's really right and wrong for him? And
yeah,
what is the real problem here? And that's where I just like to say to people, we've always talked about investing here and how to get good returns and how to get good risk adjusted returns. And we think that's the way that you add value in your life and in, anything you do with your money. And I guess what we haven't really, I think we've talked a little bit about is what are the things you need to make sure that a period like this doesn't derail you and push you off into a bad place where you're not going to recover financially for a long time? How do we avoid those pit holes? And I guess I would say, do you have money saved? Do you have money in case, you lose your job or something happens and you get injured? Is there a way for you to cover what your expenses are? Do you know what they are?
yeah,
And how much debt do you have? Is it a
right.
lot or is it a little? And if you can you eliminate some of it so that if there was a bad event, you'd be more resilient and more able to respond? Do you have a HELOC? Do you have some capacity to borrow money that's not going to be hard to get when
If you need
things,
the money.
if you need the money? Do you have a capacity to borrow from someone or someplace? And the last thing is, do you have other assets? Because I think that what used to make me real happy when I was in the beginning of our marriage is we had a house.
Yeah,
And I used to look at the house and I used to look at the equity and look at what the market said it was worth. And it gave me some confidence that there was some core there in my savings because we put all our savings into our house. And that just feels like that made me steady when the markets were volatile. So I think you need to look at yourself and say, hey, what's my rent or what's my, mortgage and how do I feel about where I live? And then, I think it comes down to can you sleep well at night?
yeah.
If you can sleep well at night, then you've got the right amount of risk. If you're
So,
having too
just
much, then you're not sleeping. I think you
so
got to take care of you first.
Steve, you're laying out basic principles, and let me overlay something on what you're saying, which is that it really depends on how old you are, right?
Oh
Uh,
yeah,
and if you're young, young being 20s, 30s, uh, you're going to have an entirely different perspective, or you should have an entirely different perspective on what's going on now than somebody our age, or somebody in their 40s or 50s, even, right? Should have a totally different perspective because you who are younger, 20s and 30s, and even to some extent in the 40s, are going to live past this
Sure.
easily.
This is going to
And
be a line on the graph that you're going to say, wow, that felt bad when it was in it. But when you look at the life of the market, your time frame, 30 or 40 years, there's, there
yeah,
is not a great deal of worry.
even at this point, if you look at an S&P 500 chart, if you look at 2000, the 2008 drop, you look at the 2020 drop, these already look like small squiggles.
We'll be right back.
We hope you're enjoying our episodes. If you are, then we'd greatly appreciate your liking, following, and sharing. Help us help others. Now let's get back to the discussion.
Yeah,
Today's perspective.
I'm not trying to diminish it because there are different people, right? We've got people who maybe just be retiring and they just saw what they thought was their total at the beginning of the month, get hit pretty hard.
Yeah,
And so I think that, this gets into this whole point about what should you be allocated and how much risk should you take. And I think that, when you're getting closer to retirement, you want to be having you take the risk off and at a higher level than having the market take it off. And that's what I just want people to be constantly looking at themselves and saying, hey, am I where I want to be? Am I doing the things I can do? And then you just leave the rest up to the assets and your allocation. I think that looking at it daily is not a good idea. And I think the media coverage tonight on Bloomberg and CNBC and everywhere having a special because it was so volatile last week. I find that to be like, why do we celebrate the negativity instead of,
right.
Celebrating the fact that we have so many great AI companies?
Yeah.
I don't
Yeah.
Well, think that we're a media of negativity.
Let
And I
me
think that
say this.
negativity can affect you.
I have no plans to watch those shows.
Well, no, that's because you're going to be working on your podcast and trying to make sure you release the best you can release. I mean, so we're trying with this to take a different approach and be more reactive to the news around us. Because we think that when we did some reaction pieces to what happened with CrowdStrike and what happened with the GLPs and what happened with NVIDIA and some of their, questions of their early valuations, we felt those were good and were received well by our listeners. So we're looking at this saying, what would you tell people if you gave them 20 or 30 minutes and you said, hey, this is really what you should think about in your overall perspective of money investing and the volatility of markets? It's a moment to learn and it's a moment to think about things that are important to you. And if you're doing those things, then you realize that these squiggles, they aren't as big a deal.
Yeah. So Steve, just to, for our audience here, in terms of, what I've been doing, okay, to prepare for this and during it, this crisis, the last 2 days, as I've mentioned on prior podcasts and in some blog posts, I have been ratcheting in beta, lowering the beta of my portfolio. I've always looked for stocks with lower short interest.
Yeah. I noticed this week, some of those really spiked up there. Like I saw Exxon at 10 or 11%.
Yeah, I mean, it's crazy.
So I wondered, does Clem have to sell all his names if that number goes up, or does he, does he say, no, I don't want to?
I'm watching this. The only problem is that a lot of the short interest comes out, the short interest data only comes out twice a month. So there's a data latency problem, but
I thought I had somebody that was telling me live on TV that they were seeing
I don't know
short interest. I thought when I looked at, and maybe that was maybe.
Yeah, FINRA puts it out every twice a month. And then forward pegs, well, they're certainly coming down a lot for some of these companies. And so, as you know, Steve, I sort of grade these stocks. But one of the things based on those criteria, but one of the things that I've done lately, and I think you would appreciate this, is I kind of multiply through those three things. I take the short interest, multiply it by the forward peg, multiply it
Yeah,
by the
that's
beta,
cool.
and
Yeah.
and it gives me like a single number. And if I see something that's above two, then short interest times beta times forward peg. If I see something above two, then I want to get rid of it, right?
Mhm.
And I like things that are sort of in the below one, or
Yeah.
somewhere between 1 and 1.5, somewhere along in that range.
Well, that's what I was going to ask you is there's different ways to adjust your beta, right? There's
Yeah,
taking it all out, putting it
yeah,
into cash, and that's going to adjust your overall beta.
yeah,
And then there's of the stocks you want to own.
yeah,
Do I want to clip some in the front end that have
yeah.
had great runs?
So
Do I want to clip some on the back end so that I can take a loss and that might help me with my taxes?
so yeah, so by getting rid, looking at those three indicators and getting rid of the ones that multiply out to two or above, I've added to my cash, I've added to my gold, and I've done something just on Friday that I think you're going to be very surprised at, which is I've added some bond exposure, but I'm going to add some more bond exposure, but just a little bit.
Okay, I don't want you to leap anywhere, Clem. You're not comfortable with, I want you to gradually move places so that you might sit there for a while. I mean,
Right.
I,
Well,
I look at bonds now and I think about whatever duration you want to look at, a 2 or a 4 year. I look at two mainly because it's kind of after a lot of noise happens in the first 6 to 9 months. And I think that you get rates over 4 or 2. So I like that
so
kind
what
of
about,
mathematics.
I mean, with yields coming down,
With
uh,
yields coming down, that's going to help us with the little capital gain, right?
yeah, TLT is going to go up.
Correct. That's a longer duration item. So
Right.
if you want to play the longer duration, TLT is the play. If you want to really play it, then you look at options on TLT.
Right.
And that's really applying leverage to something that's already kind of pretty clearly correlated to what
Right.
the market's going to do. So
TLT
like
has done okay, through the last couple of days.
yeah, I mean, one strategy a endowment told me about was they sell puts on TLT. So when it shrinks and there's demand for safe assets, they go down, the price goes up, and you look at that and you have a put in place,
Yeah.
so you can take advantage of it.
Yeah. So for our audience, if you're kind of confused, what the heck are Steve and Clem talking about with TLT?
Yeah,
It's a long-term treasury bond ETF. And so it's a way of investing in long duration, which basically is another way of saying that if yields go down, the price of this thing goes up, and you're going to get a nice solid return. Um,
right.
but vice versa, if yields go down, there's going to be a loss. So it's not something that would ever be like a core of my portfolio, but maybe
No,
on the edges it would be
no, I
like
think I
like
mean
gold.
we're trying to help people with we don't have information, so everybody should make sure that they check with their tax and investment advisors.
Right.
We're just kind of throwing around ideas,
So
and
Steve, let
I
me
I looked at the three categories, and I'd just be a little more like 20 or 30% in the bucket of the negative and the pessimistic, and I'd put probably 10 in the positive and then the remainder in the middle, which would push you a little towards more like a 15% decline overall.
yeah.
Go ahead. Sorry.
One of the things I was going to ask you, one of the things that surprised me on Thursday and Friday is that gold actually went down.
I know, and so did silver. I mean,
Yeah.
there's a lot of people in the metal space who are saying silver has not really kept up in this move in gold.
Yeah.
And is it gold moving just because of the safety trade, or are there several safety trades going on, right? You want to be out of the market, but you're also worried about inflation. So you want to pick something that you think is going to benefit in both cases. And I think when you look at silver, it probably has more of a consistent demand from dental and chips. So it probably doesn't have the same amount of speculation in it. The gold is basically being held as a speculative asset for people to hedge their portfolios.
Well, that plus also there's a lot of central bank demand for gold right now. And so
Right.
that was one of the theses by which I was holding gold. And also preparation for something that tariff drops or some kind of crisis, and that hasn't played out as well as I thought it would. Gold was really doing well, and it was a big contributor to my portfolio through Wednesday.
Yeah.
And then Thursday and Friday it didn't quite work as well. So I'm not selling any of the gold, but I'm not going to add to it, which is why I thought about the bonds.
Right. I think it's good to have different levers you touch, and I think the gold is one of those levers. When we look at government's gold, China needs and wants as much gold as it can, so try to make its currency more of a reserve currency. Right now, the U.S. is somewhere around 6 to 7% of its currency is based in gold, and China is below 1%. So they need an awful lot of gold because their economy is growing fast. And so that number keeps getting bigger and bigger. And so they don't export any gold for the rest of the world. They're only buyers. And so when you look at a buyer like China out there and you see this demand for what they want to do, if they take their money out of treasuries, what do they put it in that's going to give them safety? Would they put it in some other currency? Would they put it in? Because they know that most of the currencies of their allies are going to be currencies that are probably going to behave opposite of the US dollar. So therefore, you don't want to lock in a loss. You're trying to lock in a gain, if anything. So I think the way that governments look at this is a big part of what's happening.
So Steve, let's take it back to tariffs for a second. One big catalyst, well, two big catalysts would be if the EU decides not to retaliate, and if China decides to pull back on its retaliation and reach some kind of an agreement. I'm skeptical about both. I'm more skeptical about China because China has actually come really has had a very powerful reaction to this, not just the tariffs, but also cutting off rare minerals exports, and putting some more companies, U.S. companies, on their so-called unreliable entities list.
Right. I mean, you could tell they got serious when they, told employees no holding of Apple phones anymore.
Yeah.
I mean, they are making a clear-cut delineation that they will develop the technology that will be the leading tech in AI or other spaces going forward. And I think that if the U.S. thinks there is not a fierce competitor there, we're missing the boat. But the bottom line is the U.S. government has a lot of assets and a lot of resources. And the question I think that Xi in China is trying to figure out is, will the U.S. get so distracted by tariffs that they forget about security and they do things that are a mistake in either the Ukraine or Israel or in Taiwan? And I think those are the three international spots. And you're going to say, is there anything that could make this tariff story go worse? It would be some type of an upset in one of those three regions. That would just add to this negativity of the overall global economy. And I think that when I look at the reasons that we're going to recover, one, it could be that the market has overreacted. It could be that this stuff gets backed off after 2 to 3 days. It could be, a much different scenario. But people are being set up for a longer term problem here.
Right.
So if I was going to just pull the windows open and say, hey, what's happening? I'd say that there's more likelihood that this goes on for a period of time. So as a longer lasting item, that's why I'm more pessimistic.
Well, I think it's easy to be pessimistic about a lot of policies that we're seeing come out of this administration. um, and the inability of Congress, of this Congress, to try to get its act together. So I just, you know, we're at a bad juncture with respect to governance in the United States,
Correct.
and that doesn't help. That doesn't
Right.
help.
I guess I would say that the thing that gives me some hope is that, the Fed is sitting here and the Fed knows that if they were to do anything to make an indication of the market that they were going to support it, that would be like a moment where things would turn around. And
And yeah, and here's the problem: if the Fed decides, well, Trump got into this himself, he's got to get out of it himself. If the Fed decides that, the worst case scenario is Trump could decide to fire Jay Powell.
yeah, I think there's scenarios that are more likely this week and more likely in 2 months. And I think that it will take a while for the process to work where he fires Powell. And
Yeah.
I think it will take some time. And I honestly think the Fed will cave and probably lower rates in June instead of, September or December like they had been predicted. So I think they'll pull the cuts forward and they'll indicate that they'll cut more. And I think those two things will stabilize this market.
It
My big,
depends.
yeah, they could stabilize this market.
Yeah, it depends on
There's a lot of other variables.
yeah, it depends on whether which is of greater concern at the moment, inflation or recession.
Right. I think the Fed doesn't want to not be at the switch. But I also think they don't want to feel like they're cowtailing to Trump tweets. So in order for them to keep their respect, I think that you can't really see something happening in April or May. I think
Yeah.
that they will want to see what happens with this budget and want to see what happens with the extension of the tax cuts. If you see two events after each other, being the Fed lowers and the tax cuts are extended, you're going to see an accelerated market and too much inflation. And I think the Fed would like to see that decided before it goes ahead with the question about cutting.
They'd like to see what happens with the budget first.
Correct.
I think that I agree with that.
And I think that if we look at this thing and take a longer time frame, that's what I would say. Make yourself comfortable this week with your allocations. And if you want to sell, sell. If you want to generate some, I'm selling myself in my IRA. My IRA account, I have no taxes. So I take back some S&P exposure, and I looked and added some exposure to my FLQM, which is my mid cap, because on a risk adjusted basis, I look at mid cap as a place where you get compensated, and tariff risk doesn't affect mid cap because the companies are 80% doing their business in the US. So mid cap tends to have, and small cap and even higher, but small cap doesn't have the balance sheets of mid cap. So I'm putting some money in mid cap and taking it out of large cap and saying, okay, I'm not sure what's going to happen here, but this is in a retirement account and every situation is different. So in my mind, we want to have more dry powder. We want to be able to deploy quickly. I think the question that Clem asked is a good question about what duration you want to be. Do you just want to be the shortest treasury you can and have no risk up or down? I feel like if the market's going to tell me something, it's telling me right now that there's more likelihood they're going to cut rates than raise rates. So I think it will take months of data before we know the inflationary effect of tariffs. It's going to take more than months because we don't even know how quickly somebody might be taken off, right? We could have an agreement with France, but not with Italy. We could have an agreement, I don't know if the euro will act as one. Maybe they should negotiate as one, but Germany wants to do, I can see Trump trying to fracture the euro and trying to fracture whoever is not in, his good graces. And I look at that and say, the damage here long term is not just that he did this tariff thing, but that it just created such disruption that people now have less likely to understand and respect the US in these markets.
Yeah, he may try to help out the countries that have governments that are more friendly to his ideological perspective.
Correct. And we could see a long-lasting impact from this. What I think is probably happening is he's under a lot of pressure as CEOs and financiers go to Mar-a-Lago and try to visit and say, this is really bad for us. This is why you need to change. And I think he will do what he does, which is he would generate headlines. He would love to claim success. He's already said that tariffs are going to add, trillions of dollars to the U.S. Treasury. I think it's, one of the things that has to happen with the market is you've got to look at it as a discounting mechanism, and you need more data. Nobody knows. Therefore, I think a lot of these people on these shows and a lot of these people in the market here are trying to say, I know what's going to happen. And in reality, we know that if we sleep well, if we exercise, if we keep a balanced approach to life, there's a better chance we'll live well. I think that all of these things about market timing and market levels and how long the markets will go down, the markets will go up. And if you allocate it reasonably, you should be able to participate in a way that adds value. That's all I try to do.
Yeah, the last thing you want to do is react,
Don't
to
sell
each day's
100%.
developments.
Yeah, 100% person who gets out at one time says they know perfect information.
Yeah.
I look at it and say, do 20%, do 10%, do some number that makes you feel more comfortable. And you can look at the number and say, hey, my monthly expenses are $3,000. I'm going to look at that and say, I've saved 30 grand. I get 10 months of expenses. That's more than enough. And that's how you have to look at your life and say, hey, these things can immunize me and make me feel better, or I can continue to cognate and think about it and let it ruminate around and bounce around at night. I think I've lived that life, and I'd suggest another approach, which is get yourself to an allocation you feel comfortable, and from there, I wanted to end with an opportunity where I see something, and I see opportunity in energy, and I especially see opportunity in dividend payers. I think the overall sell-off has taken some number away from some names that were already good values, especially European companies, and made them better values. And so when I look at what's happening, I think I'm glad I have this allocation to these types of securities, and I think they add value, especially now. Because what's the likelihood that any of these companies are going to cancel a dividend between now and the next 2 or 3 quarters? Almost none. They've got cash on hand to cover the dividends, but their businesses are still thriving. I went to Costco, I went to Home Depot, went out again for dinner. They are all doing fine. I think that if you look at U.S. companies, there's some great companies, and if the price goes down, I'd suggest that people think about it, but only think about it if you have the right risk perspective. What do you think we should buy right now, Clem?
Well, apart from some bond exposure, I would, in terms of what to buy or what to sell. Okay.
Correct. Well, what do you want to be lighter in, and what do you want to have more
Well,
of?
I want to have less of all three of these things: less beta, less short interest, and less forward peg. And so when you multiply those through, generally speaking, that means right now, what that means is getting out of most technology, almost all technology, actually. It also means more consumer staples. It means more utilities, and it means more insurance companies.
What healthcare?
It means some pharmaceutical companies in healthcare. Okay. Surprisingly, I don't know, not surprisingly, there's no consumer discretionary in that mix.
What industrials?
No industrials in that mix.
What energy?
Energy, I'll tell you, we may have a difference of opinion on energy, right? And the reason, so just, a few, beyond the 3 indicators I talked about, a few observations I would make. One on energy is that we've seen a very big drop in energy prices over the last 2, 3, 4 days.
Mhm.
And, that may make your stocks cheaper to buy more of, right, Steve?
Correct. That's why I'm reacting, because I think it's gotten for areas that had higher beta. I
Right.
understand why there's a re-rating of Amazon and Nvidia. But
Yeah.
when I look at Exxon and I say what's been re-rated,
Yeah.
I agree. The thing that was a little bit that people aren't talking about as the cause of that was the fact that OPEC agreed to increase production.
Yeah.
And so OPEC agreeing to increase production at the same time Trump puts tariffs on
Yeah.
has kind of made a double whammy.
Double whammy, right.
And my question is that whammy going to persist, or is it a temporary opportunity?
Depends on whether we enter recession.
Right. And I
So
think we're
that's
not
the
going to
key.
know that for 6 to 9
Right.
months.
The
So
other thing I would mention is that, insurance, which, meets, generally speaking, insurance companies meet my criteria, but there is a problem, qualitative problem with that, in that some of these insurance companies, like All First, are dependent on automobiles, and automobiles are subject to the tariffs. And so there's an issue there that I'm concerned about.
yeah, I mean, I think that I think that all these ideas are valid, and I guess what I'd say here on Sunday afternoon is, it's a beautiful spring day. In order to have a balanced view of your portfolio, you need to
Maybe
have
where you are, it's beautiful, but here it's raining.
It's 65 to 75 today, and it's a little bit hazy, but it's still warm, and the stuff is blooming, and it's really a pretty nice spring. And so I guess I'd say to people is make sure whatever you're doing it with some thought and some care. And if you are, you're likely doing the right thing. I think if you're reacting, hold on, you should be only acting. You're acting to achieve something that is going to make you feel and believe that your overall wealth is going to be sustained or increased in the way that you want. And if it's with taking more risk and you're comfortable with it and you swallowed a couple of times and you're still going to do it, that's fine. See how it goes for a week, and you can always change. I think that when I look at things, it's trying to be a little more holistic. And I know it sounds a little bit like I should have a tie-dye shirt on and I should be in the 70s, but I really don't think we're in a position where I have a lot of systematic risk concerns. I think there are concerns about tariffs. I think there are concerns about costs and inflation, but these are not like they were when we had financial collapse around the real estate market, or we had a collapse around COVID, a pandemic. So to me, we've got a problem that's a shorter term problem, and I don't think it's been dimensioned yet. So when it gets dimensioned, I think we can react more completely. But right now, it's much too early. And I think we need to step back and just make sure we're on the right path. Anything else, Clem?
No, I think we've pretty much covered it. I would just say to everybody, don't panic. Don't react in really massive ways. Make changes around the edges if you need to, but don't think that the world is falling apart.
Yeah, I'm not going to a big box and buying anything. I was trying to think of some things. We thought about some baked beans. We thought about some tuna, but we're going to go with the system will remain intact, and we'll go shopping next week, and we won't be really kind of stock up on anything.
Yeah, don't buy anything that comes from the herd in McDonald Islands.
Stay away from the penguins. They've been trying to take advantage of America for years now, and I think those penguins, we're going to get back at them. So live well, enjoy, and until we speak again, it's Skeptic's Guide to Investing. Thank you, everyone. Please tell your friends and share us with anybody who think we can help. Thank you.
The views shared on this podcast represent the personal investment views of the hosts. They are for educational purposes and not meant to be taken as investment advice. Listeners should consult their own investment, legal, and tax advisors. Past performance of any investments is not a guarantee for future return.